So did you know that millionaires actually don't invest all of their money in stocks and equities? They invest only about 30% in stocks and about the same in real estate, and the rest in private equities and things of that nature, but about the same in real estate. And so the wealthy are using real estate to earn 15% average annual returns. They pay almost zero in taxes and retire early. Now, how do they do this? How do they actually invest in real estate? Do they own a bunch of rentals and they have to deal with a bunch of tenants? Well, maybe, but probably not. The answer is passively investing in what's called real estate syndications. So in this video, I'm going to introduce you to real estate syndications because they're not just available to the wealthy, but also to people who have money to invest in the stock market, but otherwise would never actually invest in real estate in this way. I'm going to give you 5 reasons that the wealthy use this in their portfolios to generate cash flow, build wealth, and also pay less taxes. Now, first of all, let me say that most people, when they invest, okay, the more sophisticated investors are always looking at the risk. Specifically, they're looking at the risk-adjusted return, not just what return am I going to get, but what risk am I willing to put up with, right? And so if you're looking at real estate syndications, and there's different asset classes within real estate, there's mobile home parks and self-storage and multifamily. We invest in multifamily. That's what we're really good at. So I'm going to spend most of my time talking about that. It's essentially commercial real estate in general. They share a lot of different, they have similarities as well. But one of the things about that commercial real estate, the 3 I just mentioned, multifamily specifically, is risk. It's below average risk. You always got to look at the risk as well. And so historically, multifamily has proven to be much more stable than other investment options like the stock market that's very volatile. Single family houses that got hammered in 2008. Retail got hammered in 2008 as well. Got hammered again in COVID. Office got hammered in COVID. But multifamily real estate has performed relatively stable in down markets, which is why I like that. Now, why is that? Why is it that they behave more stable than some other asset classes? And it really boils down to supply and demand, right? There's always demand for affordable housing. What I mean by that is affordable rental property. Somewhere rent $1,500 or classified as about $2,000 per month in rent or less. Anything that's less than the median if you were to buy a mortgage, right? There's a lot of demand for that because not everybody can afford to buy a house. This has been like that for decades. It's always a bit cheaper to rent over the decades. Right now, however, the gap between what it costs to buy a house and what it costs to rent is enormous. It's the biggest in history it's ever been, making home ownership very, very expensive. That's driving a lot of demand into the rental housing, but it's been like that for long periods of time. So even in down markets like 2008, when homes got hammered, right? So no one now that were underwater couldn't afford to make the mortgage, and so people essentially defaulted, walked away. And where did they go? They went to rental property, rented not a house, or they probably went to an apartment building and rented there. So multifamily behaved much better than, for example, single-family housing did in that same time. Also, COVID, for example, COVID hammered the office market, even the retail market. No one went out to retail anymore. A lot of stores, restaurants shut down and never reopened again. And we were afraid this was going to happen to multifamily as well, but that's not what happened at all. People actually paid their rents. Because I think my theory is that there's the one thing they could control is a roof over the head. And there's so much other uncertainty about their job and this, that, and the other thing. They actually paid the one thing they could control, which is their rent. And I think moving forward, this is only going to get more pronounced because it's too expensive to build new multifamily apartments. In fact, if you look at the permits, they're down by 50% over the last 12 months because it's too expensive. The interest is too high. The cost of construction is too high. And so developers aren't pulling permits for new apartment housing, right? And even if they were to build it, it's going to be Class A luxury, far greater than $2,000 per month in rent. And so what that means is that we have a fixed housing stock of $2,000 per rent or less, and there's nothing being built after that, right? So ongoing, even if there were to come another recession, this problem of affordable rental property is not going to go away. And this is why I believe that multifamily is one of the most recession-resistant investments at all. Now, number 2, the reason that I like multifamily syndications is not only because it's below average in risk versus other things you might invest in, but also because it generates passive income. Now, stocks, for example, and bonds really don't do that unless you own a lot of it, okay, and you account interest and dividends, right? Or you're doing very advanced option strategy. But if you own stocks, you know you have the 4% rule. You can only, you're only supposed to liquidate up to 4% of your holdings. So if you want to generate $80,000 per year, you would need a $2.5 million stock portfolio, right? So if you don't have that, or you want to generate more than that, then the stocks really aren't a good source of passive income. Now, you could do single family rentals, but they don't really generate that much money, right? $200 a month, if you're lucky. They're not really a good source to actually cover your living expenses. And this is really where real estate syndications comes into play, because you can invest as a limited partner in these syndications, and therefore you get a percentage ownership in a very large building. Now, the cool thing about it is that you're getting the benefit of real estate and the cash flow and the tax benefits without you having to do the work, because there's going to be an operator, also called a general partner, that does all the work. They find the deal, put the deal together, and they manage the deal, and then hopefully exit the deal for a profit. And they also get a percent ownership, a smaller percentage, but you also get you get to own a piece of a large commercial piece of real estate, and now you're getting the benefits of that cash flow. So it really is passive income, and there's passive investors that we work with that have been able to replace their income in about 5 to 10 years simply by investing not only in the stock market, but also investing in real estate syndications. Now, let's get into kind of the returns side of things. And the other third reason I like multifamily syndications is because it gives you above average returns. Now, I would argue the returns are at a lower risk than the stock market. But a lot of people are looking for higher returns whenever it's not in a stock market. It's also less liquid. It's literally tied up a little bit more. But in a real estate syndication, it is normal to expect a 15% average annual return from investing in real estate. Now, the stock market returns only about 9.5% over the last 20 years. That includes dividends. Now, this is the nominal average annual return. But the real return, inflation adjusted, is only about 6.5% to 7%. And that assumes a 2.5% average annual inflation, which, as you know, was much, much higher in 23. And so your actual return, inflation adjusted return, is much lower than 9%. And so a 15% average annual return is attractive to many passive investors who also have investing in stock. And so, as I said, multifamily routinely delivers an average annual return of 15% or more, even after fees and things of that nature. But the other thing is let's talk about the tax benefits, okay, and in the inflation adjusted return. So the fourth reason is you really get extraordinary tax benefits by investing in real estate in general, or commercial real estate specifically, because of this bonus depreciation. So what I'm telling you is that you get a 15% average annual return, and because of the tax benefits, you actually get to hold on to the majority, if not all, of that return, because of the way tax laws are written. So one of them is a bonus depreciation. You get to write off a certain part of your real estate as essentially a paper expense. And now with the big, beautiful bill being passed by Donald Trump, he brought back 100% bonus depreciation, which means that you can deduct 100% of your investment in a commercial piece of real estate in year one. Now, this is extraordinary because it offsets any kind of passive gains you have in other passive investments, and it's a carried forward loss. So what that means is you invest in, let's say, a piece of multifamily real estate, $100,000, and you get $10,000 in cash-on-cash return, but you carry forward a $100,000 loss on your K1, which is amazing. So every year you're getting that $10,000, you're not paying your taxes on that. Now, at the end, there's going to be capital gains, just like anything else. But there's other tax vehicles like a 1031 exchange that you can participate in to actually reset the tax clock if you keep the money in real estate. And just make sure you're working with a CPA that knows real estate very well and can help you navigate and take advantage of these tax laws. But the tax benefits are extraordinary in real estate. Okay, let's talk about inflation, because we talked about the inflation adjusted return. But Michael, isn't the 15% also before you adjusted for inflation? Is that inflation adjusted? No, it's not inflation adjusted. But what happens with real estate is it's more of an inflation hedge, which means that if inflation were to become higher, that 15% return is going to be higher still. So simple math, let's say that inflation is 5%. Then what will typically happen is that 15% average annual return will start growing to 20% because of inflation. Now, why is that? Why in the world would that be? That's because real estate is a hard asset. For example, another hard asset is gold. Okay, for example, I mean, there's a lot of hard things you can actually touch that have real intrinsic value. Okay, so for example, gold, they say in the early 1900s could buy a very, very nice suit with an ounce of gold. Well, today, that ounce of gold can buy a very, very nice ounce of gold. And And what happened to gold when inflation ran up? Well, actually, it was a little delayed, but it finally caught up. And so what happened, inflation eroded the value of the US dollar, not only in our own country, but also in the world. But that value of that ounce of gold went up in absolute dollar terms because it maintains its intrinsic value. And the same thing happened with multifamily real estate in 2023 when the inflation was up 10, 15% based, depending on what you were reading. It actually drove rents up by at least that amount. Actually, what it did is it actually drove it up by, so if inflation was 10%, it drove up rents about 20% all across the country, especially in the South. So what happened during that time as inflation was raging, all the costs, all the expenses went up, including people's rent. Okay, and so what that does, of course, is increases the net operating income of the real estate, which then increases the value. So within 12 months of that period, okay, when inflation was up, which is bad for the average American, if you owned rental property, it was amazing. Our valuations went through the roof very, very quickly. And this is why real estate in general, but commercial real estate specifically, is such a great inflation hedge, because if that were to happen again, we're likely going to see the same exact scenario again. So to recap, there's really 5 main reasons to strongly consider diversifying your own investment portfolio with real estate syndications. Number 1, it's passive income. Okay, it's something where you get regular cash flow without the headaches of active management as well. Number 2, you're doing so with something that is very recession resistant and therefore below average risk based on a lot of things you might be investing in right now. Number 3, you're looking at above average returns. You get, number 4, extraordinary tax benefits you don't get with almost anything else except for oil and gas, perhaps. And number 5, it is an incredible inflation hedge. So if you're looking for something outside of the stock market, as you should, to get these benefits, and you want to invest in real estate, but you don't want to deal with it yourself, you don't want to actually have to buy a house or houses and manage tenants yourself, then a really, really good alternative is to look at these syndications. And again, you can get into syndications for a variety of asset classes, self-storage, mobile home parks, multifamily, and we would love to be your multifamily trusted partner. So check us out on nighthawkequity.com. You can look at some of the investments we've made. You can book a call. We'd love to have a conversation with you, learn more about your investment goals, and maybe we can help you get into the real estate market as well. Catch you next time.